Price ladder is an invaluable tool, particularly for the shorter term trader. What the price ladder does is it gives you a much greater depth of information that you don't get from a candlestick. It shows you how the market is trading around certain levels, and this gives you a much bigger clue as to whether a level is going to break or whether it's going to hold based on what kind of price action you see at the level, whether it's passive accumulation, whether it's an aggressive bid away from a level. We'll have a look at some of these examples. I'll give you a couple of examples from Alex's course. He's got a whole course on price ladder trading strategies, so goes into much more detail as to the exact ways you can use the price ladder to implement trades without even needing the use of a chart. So let's go and have a look at what it actually shows you. You've got a bids column on the left. This is your blue boxes, and a column of offers on your right. The central grey column is the price. So in this example, the blue column shows you how many contracts are bid at each price. So here we've got 83 contracts bid at 70.46. So you've got 83 contracts worth willing to be filled at that price. It doesn't necessarily mean there's 83 people. This could be one person with 80 contracts and then 3 people with 1 contract. You don't know that, and that's what the price ladder doesn't tell you. It's the way it reacts when it gets there that's key. So that's what you've got there. In terms of actually putting a trade on, you can either rest an order and wait for the market to reach it in the way that those bids are sitting there, or you can hit market, and we'll come on to that in a moment. So next up, you've got a few reference points. You've got the volume up in the top left, tells you how many contracts have been traded so far in the day. Again, this is something that you'll get used to noticing how much is expected by 8 in the morning, by 10, by 2 in the afternoon on the US Open, what constitutes to a higher or lower volume day. Again, gives you a little bit of clue as to the way trade is going to go forward. You've then got the volume at each price. This shows you very similar information to a volume profile. And also the low of the day is that little line. The shading in grey is lighter below it. So just gives you a visual representation of highs and lows of the day. So moving on to what's actually important. You have got your current position. In this case, we have got 9 lots and it's red, so it is short, and your average price of your position. This is shown by the little highlighted box in the center. This shows the average price, so it's not necessarily where you've got all 9 lots. There could have been 5 sold higher up and 4 sold lower down, which is giving you your average price there. However it works, that's how you see it, and it is just basically an average of your position. You've also then got a working bid. So what we've got here is a bid to get out of the short position. If the market trades down into that bid and trades all the way through the bid, so in this instance, that top bid, which is called the best bid, so the one closest to market, that top bid has got 8 lots on it. One of them's ours. So we need 8 to trade to get that fill. It could be that we are the first lot and it only needs 1 or 2 to go down and it will get filled. You can monitor this and keep a track of where you are in the queue, so you get an idea of whether you're going to get out quite quickly or not. But that's how you can get out of a trade, either by having a bid or you can hit market. To hit market, what you would do is you would click above the best bid, and that would then take something off the best offer, so that 27 lot. So if you bought 1 contract at market, so at 50s, you would take that 27s down to 26, and that's how the market moves higher. All of those 27 get taken out, and then someone buys the next price as well. That's how the market moves up, and then the bids will follow it higher. So that's how the market rotates, how it moves, and it also an indication of all of your positions. Finally, that is the last trade, the box that's in the volume column, and it shows whether a trade was up or down and also the volume of it. So in this instance, the last trade was 1 lot sold into the bid at 49.5. So that's what the last trade was. Obviously that could be a bigger number, it could be a smaller number. If the next trade again was another sell into the bid, then that box would turn white, because it's showing that more trades have gone into that bid. Again, if it trades into the offer, the box will be green and show the amount traded. So let's go and have a look at a couple of examples. I've got an example of a month-end trade. This is in the FTSE and is in fact where this ladder is from. Shows much more aggressive flow type trade. The offers come in, and you see that as the market bounces back higher, offers continue to come in until you reach a point which is a level, and you then start seeing the bids start getting stronger. So to give you a good example of the flow in the market, we'll then go and have a look at a couple from Alex's course on absorption, so more passive buying and selling in the market as well. Give you an idea of ways you can play these, and also what it is telling you about what the market is doing at that point in time. So let's go and have a look at a couple of examples. Before we get straight into the video examples, just wanted to give you a few things to, one, understand the benefits of the ladder a little bit more, and also things to consider when you're actually watching it. So first up is your ability to increase size. What the ladder shows you is as the flow comes in, you can bang your size up very quickly at areas that, if you looked on a chart, would appear to offer you no reason to add anything to your trade. But it gives you that opportunity to add very quickly and then also take it off as well, so you can manage the size of your position, manage your risk without actually needing a chart to confirm anything. Next up, you've also got pattern plays, intra-candle if you will, so you don't actually see anything again on the chart, but these are things like flipping and spoofing, whereby a large order may be placed. This is to make people buy ahead of it. It's then pulled. The people who have got long ahead of the order all of a sudden have to get out, and you get the move back the other way. So that's the idea of flipping very briefly. If you can recognize those patterns, again, it gives you some shorter term trades. It may only be 1 tick, 2 ticks, but if you can spot a consistent pattern, there's quite a lot of money in making 1, 2 tick winners very, very rapidly. And also what it really does, big benefit here, is it adds validity to a move. You may have a level on a chart that if we break the level, you expect acceleration, you expect the market to move onwards. The ladder will tell you whether this is actually looking likely. So if you do get that acceleration of order flow, volume, that tells you you're right, and just adds to your confidence in a trade, and again gives you that opportunity to increase size on a break if that's the strategy that you're using. Next up, just want to give you a few considerations. Now think about these, keep these in mind all the way throughout this course, because we're going to see quite a few examples on the fundamental day, on the central banks day as well, where you see very good use of the ladder, particularly for increasing size and varying positions. So a few things to consider when you actually look at the ladder. First up is considering how the orders actually trade. Does an order consistently keep coming back at a level? If you see that, then what it's showing you is a sign of strength. There's clearly quite strong demand to buy at that level. So until that bid, I'm using in this example, goes, that level will still remain quite strong. So that reloading of a position shows a bit of strength in the market. Conversely, if you get orders chasing the market, this is showing a bit of desperation. People need to get filled, and they're willing to just go to any price to make sure they get their fill. This shows a bit of desperation, and also shows that the market is quite possibly being pushed beyond levels that it needs to be at, in which case, as soon as that sort of rush of orders has got filled, as soon as they've chased the market and got their fill, often you'll see the market come back as clearly it was just an order to try and execute a position. This could have been a broker needing to get out of position. It could have been any sort of moves. It could have been stops as well. You see this where you see a very fast cutting through of prices. Again, this is usually a desperation type move. Stops and these type of moves generally, and that is the point, generally do reverse. So watch out for these patterns as you start watching more and more stuff on the ladder. Again, if you start seeing more trade going through a market, this is a signal that a move is beginning to build up. There's more chance of a bit of a change in the market's momentum, more change of direction, more chance of it breaking areas, breaking levels, or moving away from levels. As you see that greater desire to hit market, people are clearly realizing they're not getting filled if they're just resting their orders. And finally, if you see any absorption where you should see acceleration, this again is something to be considering. This, going back to the validity of a level point that I made in the benefits, if you're expecting acceleration and you start seeing actually an absorption where you expect prices to start moving very quickly, what this is telling you is you're not getting the type of pattern that you were expecting from the chart, and gives you the opportunity to get out of the trade before waiting for perhaps a close of a candle to come back, put you offside, and then confirm that you are wrong on the trade. Gives you that chance perhaps just to get out, or at least lighten the position if it's not showing the characteristics that you want to see for the move to continue. So with those things in mind, let's go and have a look at those examples, and also keep these ideas in mind as we go through. You'll see much more examples of this in some of the later days as well. So let's crack on.
Welcome to the absorption module price ladder analysis, where we'll be looking at the Euro Bund first, then looking at the Euro stocks, and we'll be looking at two plays on the Bund and two absorption plays, where we really look at a very key region being the 45s, 46s and 47s, and we'll be looking at that in context with the volume and volatility that will be going through on the ladder, and how to observe various types of pattern. So what I'm going to be doing is I'm going to be playing this at 4 times the speed initially, just so we can get to the critical region that we want to analyze, and then we'll be looking at how we approach all the rest of our videos of how to really determine a high probability absorption play. So let's commence looking at this market now. Now what we'll be watching is this 45 to 47 area, and you can already see in a rather anomaly area of absorption being the 46 to 45, where there's approximately 9,000 contracts that have been traded over here. And let me just bring this to your attention. So let's take a draw, and so what we're looking at is right over here, this area over here. So as you can see, there's 44, 45, 46, but namely this 45 and 46 region. So that's where we're keeping a very, very close eye on as we watched the absorption area. Now do remember, what's very important is when you are watching an absorption area is to know the general momentum and the velocity of your market, and how fast the exchange does happen at per price, and also knowing when there's an anomaly area of exchange. And when you observe that anomaly area of exchange, it temporarily puts a break in the market. And when you see that break, well, then what type of trading strategy are you going to deploy in order to effectively execute? So now let's have a look again and see how this market trades. So we've observed now that there's potentially someone that keeps on reloading the 45s. You can see it keeps on reloading here at the 45, 46, and we've just jumped up to 47s. Again, it's been about 9,000 contracts, and we had a false little move below the 45s just to test. We just wanted to see if the market, and you can see now the trader is putting an order right in here at 46s. Observe that once it traded through the 45s, and we put in a 530 lot there and a 600 lot, it snapped straight back above the price again. So the moment it snapped straight back above the price again, it automatically telling you that the sellers are really struggling. They really are struggling to hold the market much below. And in the beginning, we're noticing a very large amount of exchange happening at fairly rapid pace. And rapid pace being defined of how many lots are being traded, in this instance, per second. So the play that we're looking at here is an absorption play. The pattern type is a low of day iceberger. So always know at your critical areas, either your high of day or low day, what does a high amount of volume look like, or what does a low amount of volume look like? And when you see amount being exchanged of almost 10,000 contracts in this specific market, in the Bund, once it's traded from the highs to the lows of the day, and you see the market being blocked out of the 45s and 46s, well, we're looking to execute a potential trading strategy called the iceberg partner. And what you're going to be doing with the iceberg partner is you're going to be distributing your clip size. So the iceberg partner is effectively, you're going to be partnering inside with the iceberg. So you're going to be positioning yourself where you're looking at the 167.45 and 46s and potentially the 47s, and you're going to be distributing your clip in this area. Now your risk on the trade is effectively, it shouldn't go lower than the 43s, because already we had a little peak below and the market snapped straight back above. So you're watching this area here, watching this area over here. As you see the lots being accumulated, we had 4,300 lots over here, another almost 6,000 lots over here. As the market offers into this bid over here keeps on reloading. So it disappears but then reloads, disappears and reloads. So it's either called a reloader or it's called an iceberg. And so the strategy is an iceberg partner, where you distribute your clip on the 45s, 46s, and you're scalping, between 1, 2, 3 ticks, and maybe building one little core position. So you could put in 2 lot in, another 2 lots, and then you're executing out for a couple of ticks. So just remember, that's how you want to execute this trade, where you're distributing your clip, you're scalping a few as the market blips up, and potentially holding core position for the market to trade a little bit higher. And that's how you want to be executing this trade. So let's watch how this trade is being executed. We're quite fortunate to see this trade being executed in real time. Once the trader has observed this absorption, he's clipping away with clips of 2 lots. So now let's have a look how this really trades out. So as you can see, he's waiting to get his fill. Got his fill. Now look here, it's gone 300 lot offered. But let's watch now as the market. You can see there's the absorption between 45s. Where the reloading happens, and it failed to follow through to the downside, just what we discussed. Now let's have a look. So it's 200 lot offered at 46s, and we want to see if the iceberg still maintains itself. Now it's just gone, there we go, it's reloaded the 46s. We've gone up now a couple of ticks on side, 3-4 ticks, might start scalping. So I've just scalped out at the 46s. Now you'll see that this market actually continues a little bit higher. So in the first instance, the trader just entered the absorption, scalped it for 3 ticks. But if the market comes back here again, as you can see, it's come back here again. We've got 6,000 lots now. The trader's getting a little bit more aggressive over here at the 45s. So notice it came back down, went bid back again, has bought 2 lots, actually scalped, bought 4 lots, scalped 2 out at 45s, and now it's gone on side again. So again, already there's just a lot of absorption. Now the absorption play can shift from high velocity environment, where the offers are being hit quite aggressively into the bid, and the market holds up nicely. Now, when the market really starts moving away and really starts moving towards the upside, so as the market starts moving towards the upside, if the offer comes back down and the velocity of the sell orders going through the book start decreasing relative to what it was doing in the first instance when it first started trading between 45s and 46s. So what I'm saying is, when there were maybe 500 lots going through the market per 30 seconds, slows down to 500 lots per 1 minute, well, all of a sudden the sellers are slowly starting to lose they're slowly starting to lose their power and the ability to hit the bid, and I mean to absolutely hit the bid. So what you're doing in that instance, you're starting to say, well, all of a sudden this market is tiring on the sell side, and as it starts tiring on the sell side, your conviction levels on the buy side start actually increasing. So in the first instance, you observe that there's a potential reload on iceberg, so you're more scalping. But then once the seller starts slowing down, you start saying, well, potentially the buyer is going to win this battle, and in that instance the market can actually start rotating a lot higher as the sellers, for at least this round, start giving up. So we're going to start watching how this really starts trading out. So let's have a look as we continue watching watching this area now over here. So we've been absorbed the 46. You can see the activity has started to slow down as the buyers now start really moving upwards along the price ladder, start moving up the page, and you can see, look how obvious this is. We have almost 15,000 contracts trading at 46s and 45s. So a clear iceberg, a clear potential volume slice order, not a potential time slice order, but a volume slice and an iceberg. And so the trading strategy is you join the iceberg that you observe, or if you are short, you start exiting your position. So really very key to understand where you observe an iceberg at a high or a low of a day, and it helps you manage your position a lot more effectively. So what we're going to do now, we're shifting our observation to the Euro stocks. You can see we've just gone short here on the Euro stocks. This is going to be another pattern that we're going to be trading, an absorption pattern at the high of day in the Euro stocks. Now here is what we're looking at. So let's look. So in the Euro stocks, we're looking at an absorption at the high of day. Remember, you always know what an absorption at the high of day or the low of day is when you understand your market intrinsically well. And so, in the oil market, it might be a 300 lot and a 400 lot being distributed at the high of day. In the Euro stocks, it's between 7 to 10,000 lots. So through your observations, through your journalizing, as you watch your markets day in, day out, you start getting to understand the specific personality of your market. And once you start understanding the specific personality of your market, you know what a potential strong iceberg is. And given the speed that the market is auctioning the orders, and the orders that are being traded on the book, you're able to execute a lot more confidently because you understand your market's personality. So what we're looking for here again is an iceberg partner. We're looking for an iceberg partner distribution. The market environment is high volume, moving to low auctioning activity. So what I mean by that is, firstly, there's a lot of intense volume that's going through. At that stage, you might actually wait because the VPOC has shifted, with VPOC meaning the volume point of control, where the most area of volume has been traded. So if the most area of volume been traded has moved towards the upside, and as it's moved towards the upside, if the volume velocity on the orders being traded continues in an aggressive manner, the iceberg might start giving up his position and the market could continue towards the upside. So the best way to trade this is you see the iceberg and the absorption happening, or the reloading happening on the offer side, but then all of a sudden the buy side activity starts decreasing in activity, and the auctioning starts decreasing. And the moment you notice that the auctioning speed starts decreasing, then you know that the absorber is starting to win the battle, and that's when you start actually entering your trade. So what again you want to see, first you want to observe the absorber, and once you have observed the absorber or the iceberg, you want to see the velocity exchange on the prices start decreasing, the relative rate of exchange start decreasing. And the trade, what we're looking for over here is we're looking for a scalp. Your risk management, 1, 2, 3 ticks. Your reward management is effectively looking for the low volume node here at the 82s. And as the market starts trading, you want to see how the market starts trading back towards this area over here. So let's have a look how this continues to trade. So we're looking at the 89s. And you can see, okay, we still gets re-offered at the 89s, gets re-offered, the iceberg is there, 10,000 lots being charged at the 89s, and keeps on changing. But all of a sudden, what is happening, that the bids are 1 lot, 5 lot on the bid, 1 lot again, really struggling, and the offers are a little bit stronger. There is a bit of a buy here at 88s, but once he steps out the way, and if he can't lift the 89s, well, then it's going to start to say, you can see all of a sudden the bid is still trying to maintain. There we go, 700 lots have gone through, but the offer reloads again, and he puts a nice firm stump on there of another 800 lots. 500 lots over here. Now the bid is still struggling to go towards the upside, and we're just slowly observing. What we want to see is, you see this green box here and the white box. You want to see this speed start slowing down, because the moment it starts slowing down, the auction market theory suggests that as it starts slowing down, the market will want to auction towards the other side. And as we watch over here, the market, once it starts really slowing down on the velocity, as we discussed in the previous module of market velocity, we really start seeing the market potentially moving back down towards the 82. So still watching this. The trader at the moment still holding his 89s because he's liking what he's seeing at 89s. He's liking every time the buyer steps up towards 89, he re-offers. Now all of a sudden the 88s have disappeared. So now look here, the 88s have stepped, you know, back in, but he's not taking much of 89. 89 is still standing firm. Now we've just had to go on quickly bid over. There's still some size here. The trader's still holding on to his 89s. The risk on this trade will potentially be at the 92s. You know, 1, 2, 3 ticks. Might be able to get a short, but again, the 89s holds firm. We've now had 20,000 contracts traded at 88. We've had 13,000 contracts traded at 89 and 6,000 contracts traded at 90. I mean, a significant amount of volume trading up here, and there's going to be a pinch point. It's always the ability to collect where the pinch point, where the buyers will start feeling the pain. If this market starts trading, you know, below 87, 86, the buyers will potentially start covering back towards this low volume node. So again, 89s and 90s keep on holding, and as you see, as this video continues, you'll slowly start seeing the velocity and volume on the ladder really starting to slow down, and as that starts slowing down, it starts suggesting that the seller is starting to win at this battle. And we're still watching 89 still holding, 88s keeps on. So it's this battle between 88s and 89s, but because the velocity is slowing down, it's starting to really, you know, for the first time now, the 88s are trying to hold the offer. You see now the 88s are coming and holding the offer a lot more comfortably there. 87s have been taken out now. So the 88s, 87s, now are we going to get a little bit more pain towards the downside? Are 86 going to be taken? I'm doing almost a horse commentary for you right here, but we can start seeing that the 86s have been taken out, the 85s have been taken out, and as the market slowly starts moving towards the 82s, and the trader actually exited 85s, but subsequently this market did start moving towards this low volume node. So that's really two key illustrations of absorption plays, one in the Euro stocks at the high of day, one in the Bund at the low of day. You can see at the Bund now has moved up towards the 52. So two really beautiful absorption plays, and how to scalp and trade around them, and how to potentially build a core position. And this is really important on how to position on potential volume slice orders or on iceberg partner plays.
Alright guys, what we've got here is the FTSE close. This is the month end close. So usually you expect to see quite a bit of volatility. You generally expect to see a move down as well, hence why we're already short. It's a little bit preemptive, yes. This is the last 5 minutes as well, so from 25 past until half past. Now what you're looking for is less of that passive entry and more aggressive. What you can see here is you see the offers coming very quickly, and then as the market bids back up to them, you then see the offers hold and you see the bids disappear, so you don't see any more buying into those offers as the market comes back up. So we've already moved down from 62s down to 57s, and again you start seeing those offers coming. Look at the 40s, 50s, 60 lots coming in at 57s up to 59s. These all want to get filled. Now what you need to be thinking about is, if you're someone who wants to sell quite a lot, in the more passive areas where the market wasn't moving so quickly, you could sit there and just continue to reload the offer that we saw in the previous video. You saw people just slowly adding and adding and adding to the offer, and they got their fill. Now, if the market is moving a little bit more aggressively, a little bit faster, you don't necessarily want to be waiting too long. But equally, if you're selling, if you continue to just hit market and keep selling into the market and driving it down every time you sell, eventually people will cotton onto this, and you'll see a lot of the bids will disappear and people won't take your selling anymore, meaning that you'll have to sell so much lower. So the idea is, what you'll see is you see a little bit of selling, and this is why we keep seeing the market drift back up to 54s. Initially we saw the drift back up to 56, but now it's drifting back up to 54s, And as it gets back up there, you start seeing the offers come back and they hold those 40s, 50 lots again. You see that our trader's getting out of a little bit here. Market comes back up, and notice you don't see any more people hitting markets. Very small size, and again back up to 54s. The offers start to come in once again, and that's your opportunity to sell. So we recognise a bit of a pattern here in terms of how you can enter a trade. Rather than sell as the offers start coming in and as the market starts coming off, we wait for it to bounce. You see he's left an offer there at 51, he's actually pulled that. But you can leave an offer at those areas where the market keeps bouncing up to. So we're now looking at 51s. Keep aware of the time. So we've already had 3 candles coming down the page. So we're into the last 2 minutes now, or we're approaching the last 2 minutes. This is where generally you see the volume. Watch the bottom histogram on the chart. You see the volume start picking up. You start seeing the moves getting a little bit faster and a little bit more aggressive. So we're now coming off further, and notice every time we bounce, we're not getting even to those 51s now. When it's month end as well, even during volatile times, do keep in mind levels. You can see on the chart, we've reached that previous low at 47. And once again, you're seeing this quick flush up. This is where you've had quite a strong move down. There will be a lot of people trading this anyway, trying to get in, take advantage of that volatility, and you're now getting this quick bid up for those 47s. Firstly, this could be someone willing to buy that area, but also you're moving into the last minute, now seeing traders starting to exit their positions. So any liquidity that comes in now, rather than earlier on where it was getting hit and then it would start to chase the market down, any liquidity, any offers that come in are then going to get hit harder now as people try and exit their positions. And once again, you see it down to 45s, and we get that fast bid up, and you're not seeing those bids getting taken back out now. Again, we've just seen a rush up, and this is what you expect to see. There's this volatility, this two-way action into that final minute, as you know, positions start becoming exchanged in both directions. Once again, you can see that we get to 45s, and you get this quick flush up, 44s, and push up again. So clearly there's someone willing to buy it, and even these hundreds, as they chase it down, you notice that gets taken out as well. This is giving you a clue now that you perhaps don't want to be trying to hold on to anymore. Yes, we've got quite short at the bottom, a little bit aggressive, but you're not getting any pay for it. Again, that 100 lot gets taken. You can clearly see now that the market isn't likely to push any further. We're right into the last minute as well. So this is now a time to be thinking, right, can we get a reversal on? This is the expected move. We've seen the market drive down. So you're now looking for a quick reversal and a move back up the page. We've turned, you can see the candles turned. We're now past the close of the market, and then you start to get this relief rally as those shorts get out of their positions and smash the market higher. You then get 100 lot chasing up. Perhaps this is someone still trying to hold on to a position. As they chase it up, you're then looking for them to get filled and the market to come back off quite quickly, which we do see in a moment. There we go. So what we've seen here is a lot more of an aggressive type price action, something else you want to be watching out on the ladder for when you see those fast moves, those continual putting orders into the market. They take out the next price and then they keep coming in at a lower price. This is a more aggressive type of price action and something where you can be a bit faster at market.